How to invest like a pro, 3 different methods. If you are considering investing for the first time, or if you would like to improve your approach, a smart place to begin is to turn to those individuals who invest for a living by observing how they approach the process. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about how to invest like a pro. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. In particular, when investing is not something that you do on a daily basis, it can appear to be an intimidating task to master and achieve success in the field of investing. The good news is that there are a few simple things that you can do to assist you in maintaining the trajectory of your investments. Number 3. Think long-term. It is advisable to approach it as a long-term endeavor that spans a number of years since, as history has shown, investors who are patient and committed tend to be rewarded for their efforts. There is a widespread consensus among market professionals that it is nearly impossible to accurately time the markets. There is a high probability that your investments will experience times in which their value decreases. However, if you remain patient, there is also a good chance that they will return. It is possible that investing is not the best option for you if you believe that you will require the money in the following year for something such as a wedding or a holiday payment. However, if you are interested in accumulating a savings account for the future, this could be an excellent choice for you. The idea behind this one is to avoid placing all of your eggs in one basket, which means that you are spreading out the risk and exposing yourself to a wide variety of options. Many experienced investors are of the opinion that the most effective method for constructing a well-balanced portfolio is to use a variety of various investments. Through exposure to a variety of geographical places all around the world, diversification can also be accomplished in another way. When certain investments are having difficulty, there is a possibility that others are increasing, which means that you will have a more streamlined journey over the course of the long term. Number 2. Invest regularly. This concept is referred to as pound cost averaging, which is a technical term that describes the practice of investing small sums of money on a consistent basis. Due to the fact that you are investing regardless of the situation the market is in, it helps you become a little less emotional in your approach. In addition, it is a method for avoiding indecision in the event that you are seeking to timing the market, which is something that we are aware is quite difficult from the very beginning. Suppose you unexpectedly receive £1,000 thanks to a bonus or a nice relative. You should make a plan to invest it in 4 separate investments of £250 each at regular intervals, rather than investing it all at once. Making investments in this manner can provide you with a buffer against the ups and downs of the market. As a result of investing your money in a consistent manner, you are able to make investments across the whole market cycle, eliminating the need to attempt to time the market. When it comes to investing, there is always a degree of risk involved, and as the disclaimers tell us, you might get back less than you invested. Risk is a matter of personal preference, and it can be challenging to determine the level of risk that you are willing and able to take on, as well as the implications that this has for the kinds of investments that are most suitable for you. This is something that a financial advisor may assist you with, and they might recommend that you begin by investing a tiny amount and see what occurs. Number 1. Are you an active or passive investor? If you are new to investing or have a little bit more expertise, but you do not necessarily have the time to watch the markets every day, then a fund may be a suitable alternative for you to consider buying stocks in. Active and passive funds are 2 of the most common forms of investment vehicles. A team of seasoned investors who are in charge of managing active funds are in charge of carrying out all the laborious tasks on your behalf. Whenever you invest in them, you are required to pay a management charge. The term active management refers to the ability of managers to alter the composition of investments in order to accommodate shifting market conditions. As a result of the lower fees associated with passive funds, which are frequently referred to as index trackers, a greater portion of your money is invested. They follow an index in a passive manner, such as the FTSE 100 in the United Kingdom or the S&P 500 in the United States. But there is no active management involved. Individuals that specialize in wealth management can also be hired to actively manage your investments. These individuals can choose between active and passive funds, or both types of funds, depending on the type of service they provide. In the event that you are unsure about which option is best for you, it is recommended that you consult with a licensed financial advisor. While investing can be an exhilarating ride, it is essential to perform some research to choose which strategy you would prefer to pursue in order to maximize your returns. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.